everybody. Thanks for having me. Basically, what this is going to be about is the growth stock investing system called CANSLIM. And we'll get to what it is and everything. But on the right here, I think it is a very, very cool thing written by William O'Neill, who is kind of the inventor of this methodology, if you will. And it's his basically analysis of Apple. And Sunny, it's interesting. We were just talking about before we started recording how you bought Apple and have made some nice profits on it. So it's interesting to see his write-up about it. And you can see some buy points, some base patterns here that we'll talk about in a little bit. And also, of course, the earnings growth down here. So you'll be able to make sense of a lot more of this if you're not familiar already with this type of charting and methodology. But I think this is a really cool way to start people off and show them the process.
Awesome.
So this is kind of the agenda that I want to follow. We'll talk a little bit about my background, which I already covered a little bit. Then we'll discuss about why individual stocks versus index ETFs. Sonny, I know you want to talk about that a little bit. Then we'll discuss a little bit William O'Neill and kind of what CANSLIM actually is. Then we'll get into the methodology, both the fundamental side of things as well as the technicals. Then we'll go through some 2020 examples, and then we'll finish it off with a Q&A. And a disclaimer, of course, I'm not a financial professional. This presentation is for educational purposes only. Investing in the stock market involves significant risk of loss. You should consult a financial advisor before doing so. So we talked a little bit about my background, but I thought I'd just summarize it a little bit. I'm currently a mechanical engineering graduate, pursuing my master's. As I said, I got started by this class, Introduction to the Stock Market and Technical Analysis, taught by Dr. Eric Wish. I was then a TA for the semester after I took it, as well as the 2 following semesters. So I basically took it 4 times in a 2-year span. And then, as I said, I started my YouTube channel in May 2019 to basically democratize everything, try to spread what I learned, and help out other people. And my favorite thing that I do is I interview basically very experienced traders who often follow the CANSLIM methodology. Jim Ripple is a hedge fund manager. Oliver Kell is the U.S. investing champion of 2020. He finished with a return of 941%, a verified return. So he's a fantastic trader. We walk through his process, his background, how he picks stocks, how he enters them. So definitely highly recommend that if you haven't seen it yet. Pat Walker, great educator, very experienced CANSLIM trader. Kathy Donnelly is one of the authors of one of my favorite books called The Life Cycle Trade. Leif Serede is the U.S. investing champion of 2019, another fantastic trader. And Ross Haber is one of my mentors and fellow Traderline, traders who basically helps educate people at Traderline, which is the company that I work for. So those are so fun doing the interviews. I learned something new from every single one. And I find it's a really good platform and way to basically pass along knowledge that all these people have picked up along the way. Then last year, I basically took the Mark Minervini Master Trader Program. I'm also the district IBD meetup co-leader where we give presentations similar to this. It's completely free. And I just gave a presentation, I think a few weeks ago on how to find true market leaders, basically how to pick stocks that can go up 100, 200% in a very short amount of time. So that's a little bit about my background, just so you get a sense of who you're talking to here. And yeah, that's a little bit about me, and let's get into it. So Sunny, you wanted me to talk a little bit about the benefits and the pros and cons of doing individual stocks versus index ETFs. And I think this page pretty much summarizes a lot of things about it. On the left here, you have from Investors Business Daily, basically the top performing stocks of 2020. You've got Tesla up 743%, Fiverr up 730, Twist up 572%. So some incredible gains here. And this is cut off here, but obviously there's so many more that increased 300, 200, 100%. There were a ton of options last year. And over here, you've basically got the performance metrics of some popular ETFs, popular index ETFs, the SPY for the S&P 500 and the QQQ for the NASDAQ. And you've got the kind of metrics going back a few years. 5-year return is very good, 25%, 10 years, 20%, still fantastic. But if you can catch a few of these winners over here every year, even just 1 or 2 for a little bit of their moves, you can most likely outperform these metrics. So that's it in a nutshell. There's more time and effort involved over here, but you can really achieve some incredible returns by catching a few of these moves, which basically the CANSLIM methodology allows you to focus and potentially position in these type of names.
Yeah. Do you think that, as a 20-year-old trader investor, it might make sense to be able to take on that kind of risk? Well, let's say if you're in your 50s, would you feel comfortable taking that approach on the left?
Yeah, it's a great question. And I think it's up to everybody basically how they want to do it. There's kind of the 80-20 system where if you're a little bit further along the way, you can do 20% of your portfolio in growth stocks and more kind of higher volatility instruments, while the 80% is dividends, index funds, the more passive approach. So
yeah.
As a young person, like you said, I can take more risk. But if you're more established, you're maybe retiring in 10, 15 years, you might want a mixture to kind of get those benefits of those growth stocks, but also the 80% is a little bit slower moving, steadier, and hopefully kind of smooths out that equity curve a little bit, if you will.
Yep.
Yeah, cool. So this slide as well kind of summarizes it pretty well. Individual stocks, you can get a little bit more performance. There's the kind of fun treasure hunt aspect of finding the next great stock, but it is a lot more volatile. You've got active management here. It takes a lot more time, especially if you're working full-time as a dentist. It takes time on the weekends or after the market close after your job. And that definitely is something to consider when choosing what process and what method to use. But definitely with CANSLIM, you can go all the way from more swing trading, more active, all the way to longer term position trader. I know people who only look at weekly charts, only look at the 30, 40 week and do incredibly well. So even though there is more time investment with individual stocks, I think it's certainly manageable if you commit a few hours on the weekends to do it. And yeah, on the right here, we've got index ETFs, a little bit steadier returns. It's much more passive, but there's decreased performance. If you can't always benefit from a Tesla Fiverr, it's going to reflect on your over that year. These basically indexes are composed of all different types of stocks. So if some do really well, they might get bogged down and held back by some poor performers. And if you're your own kind of active manager, you can focus only on those kind of top tier growth stocks that are performing well. So it's a mixed bag. And right down here, I say, which is right for you? I think most likely the best answer is a mixture of both techniques. You want a little bit of both, depending on your own situation, how much time you can commit to it, your lifestyle. All these are incorporated into these type of decisions.
Yep.
Yeah, so getting into kind of what I focus on individual stocks, I want to discuss a little bit William O'Neill, who's kind of the founder of the methodology that I follow. And he basically was a new stockbroker, and he basically wanted to determine the best method of how to invest your money, of course, because he wanted to do well. And he essentially studied the greatest performing stocks going all the way back to the 1800s to try to identify common characteristics that they shared before and during their large increases. And the result of that study is basically the characteristics that we're going to discuss that are the CANSLIM characteristics. Each letter stands for a different characteristic. And the methodology is summarized in this great book, How to Make Money in Stocks, which even if you're not interested in CANSLIM, I think is a great book to read to kind of expand your knowledge a little bit. It'll definitely give you ideas. And there's actually a section here about using top growth funds to invest your money. So if you're more on the index fund side of things, if you take a portion, that 20%, 30%, what have you, and invest in some top growth funds that do well consistently, that's another way to achieve very, very good returns. So definitely recommend checking out this book, How to Make Money in Stocks by William O'Neill. And this strategy basically combined both fundamental and technical analysis. So a lot of people say, oh, charts, let's only focus on charts. Let's only focus on what the chart patterns are doing. And some people are on the other end of the spectrum, PE ratios, valuation, models, all of that. And his approach basically combines everything together. So benefiting from these aspects as well as these, which I think is just kind of the logical thing to do, honestly. Use as many tools as possible to get the best result. And he also learned from the great traders of the past, Jesse Livermore, Nicholas Darvis, Jack Dreyfus, Richard Wyckoff, some great performers here. And everything that he learned is basically summarized in the CANSLIM methodology. And I think this quote from him is a great way to sum everything up. The number one market leader is not the largest company or the one with the most recognized brand name. It's the one with the best quarterly and annual earnings growth, return on equity, profit margins, sales growth, and price action. So incorporating both fundamentals over here, as well as, of course, the price action is so important.
Love it.
Yep. And I think, Sonny, you posted it on Facebook that we'd be giving this presentation, and someone was like, prove it. It doesn't work. What are you talking about?
Right.
So I thought I'd include this this slide here, this quick slide. Basically, people have done studies. How effective is CANSLIM? And basically, they found that it's pretty effective. 30.86% return throughout these years. There's been a lot of similar studies. Obviously, nothing is perfect. It's a methodology, especially in the market. A lot of it is up to the individual person, but the overall process, which is what they teach you, is sound. And I know a ton of successful people who have been doing this for decades. My professor, Dr. Eric Wish, he didn't start making money until he found CANSLIM and adapted a little bit to suit his own needs. So even though CANSLIM is a proven methodology, you have to apply it, tweak it so it fits your own time frame, lifestyle, all of that, and make it your own. So if you want to check out these studies, I've got the link down below. But yeah, definitely, I think it works. And a lot of people I know are basically proof of it, hedge fund managers, all of that.
Yeah, I was just going to say, people should realize that any stock that they buy, they have to own ownership of that stock. I mean, don't buy it just because you see it posted on a message board. Don't buy it just because you see it posted on Twitter or YouTube and that kind of stuff. The goal is to, share ideas, exchange ideas. But at the end of the day, you have to be 100% confident with whatever you're buying. If it's a stock that it's got a lot of trend following behind its name and it may do well, doesn't always mean it's the right stock for you. It just means that it's out there. But at the end of the day, you have to really take ownership of each and every single dollar that you spend buying and investing in that stock.
Yeah, and I see a question from Lance here. Has it survived a massive market correction like the dot-com bubble? Well, O'Neill was in cash for most of that, and Ross Haber, who is a William O'Neill portfolio manager, working with him and under him at that time, they were all in cash because they noticed the signals. Basically, the market leaders had topped. They were all declining from their peaks. The market was not right, and they were in cash throughout much of that decline, and not getting back in really a few years later when we got that final fall through day and things started working. So it definitely is a methodology that is all about being in the market when the environment is right for your style, not being in all the time, which is a little bit different than index funds and more passive styles. But this is a way to kind of more actively manage your money and protect your mental and financial capital at the same time. Yeah. Okay. I think that's all the questions there about that. So I guess let's get into what CANSLIM actually is. And as I said, it's an acronym. It stands for these things right here: current earnings, annual earnings, new products, services, new highs. S stands for supply and demand. L is leader versus laggard. And obviously we want to be focused on the leaders. We want to see institutional sponsorship. And as I said, we want the market direction and market uptrend to be with us. So we're trading with the trend, not just with the individual stock, but also the overall market. We have the wind at our backs, and things are working not just in the stocks we're buying, but the overall indexes are in nice uptrends, trending above those key moving averages. So in short, that's what CANSLIM stands for, and we'll go through each of those letters in depth. So the first letter is current quarterly. The first letter stands for current quarterly earnings, and stock prices in general trend with earnings growth. And we want to see at least 25% earnings growth, the latest quarter reported. And we also want to see sales growth and margin supporting that earnings growth. Because if we see a stock's earnings growth grow 80%, but sales were actually down, that might tell you that the process that they increase those earnings isn't really sustainable. Maybe they cut some R&D projects that were investments for the long term. So basically sacrificing the long-term goals of the company in exchange for just one financial report. So you got to keep all that in mind. And ideally, you want to see earnings growth over 50, 100%, supported by sales growth over 75%, 50%, and margins improving as well. And that's kind of the magic elixir. All three of those things in coordination can really lead to some dramatic increase in the stock's price. And we talked a little bit about Apple. I guess, Sunny, I knew you were going to mention that in the pre-show. But anyway, we've got the quarterly earnings plotted in wire charts down below here, and the stock price. And the stock price and the earnings is exactly the same trend. And this is really what institutions and funds are looking for to establish positions in a particular company. And this is a picture of MarketSmith. And down here, they report the earnings comparing this quarter to the same quarter 1 year ago. And then you've got the earnings growth here. And this is Apps Digital Turbine, a very strong stock in 2020. And this is all driven because of those earnings were exploding, 67% growth, 160% growth, 200% growth, 320% growth. And not just the earnings were doing well, but the sales were accelerating up over 100%. Margins were doing better. So the company in general was doing amazing. And that's what led to this dramatic increase from under 10 right here to basically near 100 at one point. So basically almost a 10x in 1 year. This is all driven because of the earnings, because funds were increasing their positions, which we'll get to in just a second.
Yeah. Let me ask you this question about, when we're looking at some of these companies, especially companies that benefited tremendously because of COVID, from the standpoint of a lot of that demand was pulled forward. Maybe these companies would have grown, but maybe not as fast. Maybe these were going to be the companies that would have been the companies of 2020, decade 20s. So my question is, when a lot of that demand gets pulled forward, and then some of these companies come out and say, well, we're not going to give guidance for 21 right now, just because we're not sure where things are headed. At that point, do you exit the stock, or that, okay, they might have experienced this massive explosive growth, but growth is going to slow down to maybe 20s or 30%, 40%, but they might have just experienced 100% growth. What do you do with situations like that?
That's a great question. So using CANSLIM, we buy on both technicals and fundamentals, but we sell only on technicals. So for me to sell a stock, the technicals have to break key moving averages, drop on high volume. Basically, I'm looking for signs that the character of the trend has changed and institutions are now distributing stock versus accumulating. So throughout this trend, it barely violated the 50-day moving average, but recently after the screenshot was taken, it broke that level finally. So that's a sign, that's a character change. So for me, the technicals have to line up with everything. The big funds and institutions can do so much better research than all of us. They have thousands of analysts who can really know exactly where all these industries are going. And if they start selling stock, that's what I want to be doing too. And that's going to show up on the charts just because of the amount of capital that they move around. 70% of the activity in the market is institutions. And that shows on a chart, whether they're accumulating shares or distributing shares. We can see that on the chart. And as retail investors, ride that trend, not trying to get the top, not trying to get the bottom, but riding the meat of the uptrend. And when that trend changes, basically moving on to another stock and moving on to a new opportunity that maybe will continue to grow when COVID isn't so much of an issue, which hopefully it won't be for too much longer. But I'm looking for the technicals as well as the estimates for the next year. Apps still has very strong estimates. So until those estimates get revised downwards, and we'll see a red triangle here, and we'll talk about annual earnings in just a second, but those estimates are brought to you by those analysts. And if those start getting marked down, as we've seen from a few stocks like Peloton, that's also another signal to me that trend might have been just accelerated and we won't see too much growth in the future. So I guess in summary, I'm looking at the technicals as well as the annual estimates to try to get a sense of, is this just a COVID play, or is this something that's really going to be sustainable and continue to accelerate? Which I think a lot of the trends will continue to do so. Fintech, e-commerce, I don't think those are going away anytime soon. I see too many Chewy boxes around me in my neighborhood for that to be the case.
Yeah.
Yep. Cool. Great question. So next thing is annual earnings, where we'll get into some of the things I just said. Institutions look for consistent and significant annual earnings growth, look for at least 25% annual earnings the past 3 years, and also watch for breakout years where you have significant annual estimates and increases in annual earnings. So down here, I've got a couple kind of snapshots of Zoom, Fiverr, and NVIDIA, showing a little bit of what I was just talking about. This is what I call a breakout year with Zoom, 2020 and 2021. We saw the company go from 0.35 cents a share basically to $3.34. That's an enormous increase. And that's why the stock went up $5, because it was going to earn so much more in the future. And right now we still have growth, but it's nowhere near what we saw. I mean, these were just estimates way back in May, June, July, when the stock was within its uptrend. And these estimates were up 999%. So now that money has came in, and right now the stock is basing because we don't know if that growth is going to continue to accelerate like that. And the estimates right now are for much slower growth. So it's great to keep an eye on that. This is Fiverr. It's still got great estimates for 2022, which may indicate that the kind of self-employed consultant role where you're kind of working on a lot of different projects through Fiverr, the website, is actually going to continue to increase. And you've got estimates up 200% for 2022. That's huge growth expected. And the estimate revisions are up. So I don't know, right now it looks like this trend may continue, but obviously the price action has to match up with that thesis. And then down here, we've got NVIDIA, a more kind of steady grower here, where the stock price obviously is a little bit more steady because it's a more mature company, more shares in the float. And you can see it's got steady earnings growth, which is what institutions love to see, and great estimates for 2022 as it's been basing up 33%. That's significant. And you can see for 2023, it's actually down 11%. So I like looking at both the current year estimates as well as the next year to try to determine how analysts are looking at a particular company. And like I said, I'm looking for breakout years and significant annual estimates. I think anything over 25, ideally 50, 100% is significant. So really keep an eye out for that type of expected growth. That's really what institutions like to see. Yep. So the next letter in CANSLIM is N, which stands for new. And that can be a new product, a new service, new price highs, new management. All of these things are basically things that can turn around a company. And you want to see basically significant changes in the company, which can spur earnings and price increases. And innovation leads to growth. And this can be fueled, as I said, by new products and services, or even a new CEO. We saw AMD get turned around because they got a new CEO. I think it went from under $10 a share to now where it is right now, up near 80 or so. And every stock, and this is about new highs right here, every stock, if it's going to 10x from $100 a share to $1,000 a share, has to make a new high every single dollar, every single cent along the way. So I know people who aren't really growth stock investors are kind of averse from buying new highs, but often that's just kind of the start of a major uptrend. Down here, I've got Amazon. And back here, when it just formed its kind of IPO due diligence phase, broke out to new all-time highs right here. And looking back, this was a great spot to buy. But obviously, it's scary in the moment if you're not used to buying breakouts, which is kind of the growth stock strategy here. But yeah, every one of these bases had a breakout, and it went on runs of 20, 30%, 40%, based again, broke out again to new all-time highs. So within this long run, if you're going to catch a stock that goes from 100 to 1,000, and this one went to near 4,000, you have to be willing to own a stock that's breaking out to all-time highs. That's where the big money is made. Yeah,
I love the horizontal trend lines, and I think it's scary because if you think about, Amazon's one of those companies that I think went down 89% from their IPO high.
Yeah.
And when that happened, a lot of people got out of the market. But then when it went back up to its IPO highs, a lot of people got out of the stock thinking, well, I broke even, I'm going to get out of this stock, I'm done. And then not knowing that this thing is going to be, a 20, 30, 40 bagger moving forward. So yeah, it's one of those things where, hindsight's 2020, but looking back at some of these stocks, if the growth is there for that company, is the revenue growth is there, especially a lot of these growth companies don't necessarily have profits, but for them, it's really about growing the revenue. As long as that's there, they're moving in the right direction, and the share prices can keep on going up.
Yeah, and I like what you said there about people waiting to sell when they're break even. All these people that bought in here, that's why on this right side of the base, there's consolidation, because there's supply coming to the market from people over here who sold to get to break even. But institutions who are the strongholders, the people who are holding for years, who expect this type of growth from Amazon, who believe in the company, those shares are getting transferred from weaker holders to more long-term holders. And this breakout signifies a change in balance between the buying and selling pressure, indicating that buyers and institutions are in control. And that led to this breakout. And that's why a breakout to all-time highs is actually the most bullish thing that you can see, because there's nobody waiting to sell up here. Everybody who owns the stock is at a profit. And any shorts who are holding here are getting squeezed. They're under pressure. They're going to have to sell, not sell. They have to cover their shorts, and that adds to the buying, and that adds to the kind of rapid move that you can get on these breakouts. Is the supply and demand characteristics being in such a way that it's conducive to very fast moves in a very short amount of time, basically.
Right.
Yeah. Did you have a question? Sorry.
No. Go ahead. No, it's just a beautiful chart. So.
Yeah, Len says he thinks COVID is going bye-bye. I hope so. We'll see. Hopefully we can get some vaccines to everybody. And yeah, we've got a comment here. If printer goes burr, yeah, the Fed obviously has a huge impact. QE, they really turned it on in March very quickly, a lot faster than usual, a lot faster than 2008. And that definitely helps. That helps so much to spur growth.
Sorry, go ahead. One of the questions earlier was that, what if the Fed had not stepped in?
Right.
And I think it's almost a situation that it wouldn't happen, that they wouldn't step in, just because knowing what happened back in 2008, 2009, knowing what happened back in 2000, 2001, I think there are things that the Fed has learned over the years. And yes, I mean, it sucks to add trillions of dollars to the national debt, but not doing so could be a lot more devastating. Not doing so could keep, I mean, millions and millions of people out of jobs right now, and not let some of these companies grow the way they have been. And it even goes back to, I mean, I don't think and I'm not trying to make this political, in the sense that I don't think we would have the vaccine that we have right now if we didn't have synchronized forces behind, from the money standpoint, to get there this fast. So it sucks. I mean, there's no doubt that it sucks having all this debt on the balance sheet. But at the end of the day, the hope is that you're going to be able to pay off some of that debt by growth and of course, higher taxes at some point. I mean, that's going to happen. But that's a conversation for another day.
Yeah, absolutely. I see some questions here about predictions. I don't try to predict anything. I'm just kind of following the trend and following what the technicals are saying. You do not need to know what's going to happen in order to make money in the market. You can follow the trends, follow your rules, and that's sufficient. Just a quick aside on that. And anybody who says they know what's going to happen, they don't know. They're just reacting to everything. Yeah, so I guess moving on, I thought this was an awesome example. I posted this on Twitter, and nobody seemed to find it as interesting as I did. But this is a chart of Netflix. The price action. These are monthly charts here. So each of these bars represents 1 month's price action. We've got the IPO here all the way until basically current times. And Netflix really had 3 different phases in its life cycle. We had the first run, which was driven by the DVD rental system, where they're reaching 1 million subscribers. That started here, and you can draw a line here. I can't draw because this is just a screenshot. But this run here, when it broke out to all-time high, that went from this is obviously there's been some splits here, but it was more than a double in a very short amount of time, just basically 1 year here. Then once again, it consolidates. There's some selling pressure here. The market wasn't right. It consolidates for a while. And then they have their kind of second phase of their company, which is the innovation and disruption of the DVD rental system through online streaming. And this drove so much growth, and you can see it in the earnings here. And that's when it went from basically 4 to, let me move this here, 4 to 40, a 10x move, because once again, a new phase, a new disruption, the company adapting and finding a new stream of income. But then if you look over at the earnings, the growth really dried up. This drop here is 2011. And in 2011, it goes up here. We went from 0.59 cents a share to the estimates in 2022 and the earnings being 0.04 cents. So they dropped dramatically, and that's reflecting the stock's price. But then Netflix innovated again. So they keep doing this. This is what great companies are able to do, come up with new products and services that boost revenues and earnings. And they basically launched their first original content that they produced, the House of Cards TV show, which is a favorite of mine until unfortunately how it ended. But anyway, this spurred another huge run, which it's currently on, from around 15 to now over 400. So I thought this was interesting to see how the price action is affected by the fundamental changes in the company. And those same changes are reflected in the earnings, which is really what drives the price in the long run. So I thought this was pretty cool. Hopefully you guys do too, and I'm not wasting your time. But I thought this was cool. Yeah. And it's cool to just picture that in a company that we all know and love and probably are all subscribers to, all the different innovation and phases they went through. Okay, so the next letter is S, and stands for supply and demand. And we want to be looking for basically signs that the supply and demand characteristics are right, so we can enter stock and it'll increase a lot over the near term, whether that's weeks or days, weeks or months, or even years, depending on your holding period. But we basically always want to see winning characteristics and accumulation signs that big institutions are driving the current move. So this can be strong increases on volume, as we see from NEO here, gap ups on volume based on earnings. And there's all these different kind of lists of characteristics that come together, and you can learn through technical analysis that just kind of increase your probabilities that a stock will work. And a big key thing, as we've already talked about, is looking for stocks near 52-week highs, basically showing that buyers overall are in control of the stock price. A stock that is near all-time highs, buyers have pushed it up there. So that's kind of what I always want to see.
Yeah. And I want to add that a lot of people say, and I hear this all the time, that the stock's near its 52-week high, or the stock's at all-time high. This is not the time to buy. This is the time to sell, and that kind of stuff. But
Right.
Looking at some of these charts, it's quite the opposite. I mean, and as a matter of fact, William O'Neill, he talks about how you should be buying stocks near the 52-week high. So I think it's worth noting that, just because the stock has made significant movements doesn't mean that it's going to stop there. And it can obviously continue to go on and make new all-time highs all the time for the foreseeable future.
Yeah, absolutely. I bought NEO on this breakout this day and this day. I didn't catch all this move, but I got some nice trades within this run. But at this point, it had already increased 1,000% from the March lows. And you might be thinking, wow, that's way too much. There's no way it can keep on going. But right. The supply and demand characteristics, it was tight. It was pulling back on below average volume, forming nice constructed bases that we're taught to look for, really tight price action, basically a sign of institutional accumulation. And it kept going another 300%. So I didn't catch this entire run, but I got some nice trades within this. And if your mindset is it's all-time highs, it can't go higher, you're basically restricting yourself to, basically you're not going to be able to hold a lot of the greatest winning stocks of all time. All of them made their significant runs in all-time high territory, as we saw from the example. If a stock's going to go from 100 to 1,000, unless it already peaked and came all the way back to 100 and decreased 90%, which is very rare, that's much more likely to happen in new all-time high territory than when a stock's already been there.
Right.
Yeah, cool. So the next letter is L, which stands for leader versus laggard. Obviously, we want to be focusing on the leadership stocks. And basically, I define that as looking for stocks in the top 40 industry groups defined by IBD. And I'm looking for the leading fundamentals and also price action in the group. And this is especially important because from William O'Neill's studies, 37% of a stock's price movement is directly tied to the performance of the industry group it's in. And another 12% is due to the overall sector. So about 0.5% of the move is entirely due to the respective group. So this is a very important part of stock selection. You want to be focusing in stocks that the overall industry is in a tailwind. So e-commerce in 2020 was huge. So that's why Etsy, not Fiverr, Chewy was doing well. Amazon, you had all these different stocks that were doing well within that group. And that is kind of where you want to be focused in the groups that are doing well, and then the leaders within that group. That's where you get some really nice returns. And the next part of the puzzle is institutional sponsorship. As I said previously, the large runs, the uptrends, are spurred by institutional accumulation. More and more funds buying shares of the company because in the long term, they believe it's going much higher and they believe in the company, the innovation that's happening. And this is really evident in the number of funds as well as the quality of funds. And this is MarketSmith once again. They can show you each quarter how many funds own a particular stock. And here we've got Etsy, which I was just talking about. But from March 2019, it had 626 funds, and it's basically doubled since then. And do you think the stock price is not going to do well if there's basically double the amount of funds invested into the stock? This is what drives long-term growth, increase in fund ownership, as well as the total amount of shares owned by these longer-term holders who believe in the company. And you also want to see, as I mentioned, high-quality fund ownership, because some little hedge fund isn't going to matter as much as Fidelity Contra Fund or big funds with great track records that manage billions of dollars of capital. That's really what you're looking for, those long track record funds that do well consistently year over year. If those take up a position in a stock, that means that they really believe in that company.
Yeah. Is that list updated, the institutional list, is that updated once a month or?
Yes, I believe it's every quarter. If you look at it, March, June, September, yeah, so about every quarter. So it's a little bit delayed, but from the price increases, you can kind of get a sense that funds are accumulating anyway. But this is always good confirmation to see. And this is also a really good way to look for potential leaders is you can scan for stocks that increase in fund ownership 25% or so. That's a great way to screen. And that will bring up a lot of great stocks that could present good buying opportunities. And the most important really of CANSLIM is the market direction. We touched on this a little bit, but 75% of stocks follow the market trend. And you always want to increase probabilities in your favor as much as possible. You want to trade with the wind at your back. And we can use key moving averages to very quickly and simply differentiate between uptrends, downtrends. And we also want to be on the lookout for accumulation distribution signs. And here I've got a few different moving averages. The 21 EMA is in purple. It's a little bit small. Blue is the 50-day moving average, and then the 200-day is this gray line. So if a stock is trending above the 21, 50, and 200, that's an uptrend. If it kind of is chopping around, that's a little bit sideways, directionless, trendless. I personally, as a more active trader, want to be kind of avoiding that, but it's not a significant change for a longer-term holder. But a break of the 200-day is a more significant occurrence. Basically, during those huge downtrends, 2001, 2002, 2008, 09, it broke the 200-day, and then the 200-day started curling down. I never want to be in the stock market when the 200-day, the 40, 30-week are curling downwards. That's the basically sign that the market is not right, and it's going to need a lot of healing before it's time to get back in the market. And this happened, you can see in 2018 and 2020 as well. And then once again, we get a very strong uptrend with all those key moving averages working in the right direction. And a lot of the time, the stock price will oscillate back above the 21 EMA. And it's just a really useful guide and a very quick kind of visual indication of how the trend is.
Right.
Yeah, so I guess putting it all together in terms of fundamentals, we want to be looking for the fastest growing companies and leading industry groups and sectors with their own personal tailwinds. We want stellar earnings growth, sales growth, margins growth, large annual earnings and estimates. We want them to be a disruptor with revolutionary products and services. And we want to see increases overall in fund ownership and also quality funds owning shares as well. And finally, we want to see basically good supply and demand characteristics. So we want the stock to be near all-time highs and within a strong market. So that's kind of the fundamental side of CANSLIM. And I guess I'll pause a little bit if anybody has any questions about the fundamental side of things, and then we'll move on to applying CANSLIM and also the technical side of things. So if anybody has any questions or comments, let me know down below. Be happy to answer anything.
Yeah, I got a couple of questions. So when you
Sure.
talk about investing in these growth companies and that kind of stuff, right? So I'm kind of going back to November 2020 after the elections, when we noticed a lot of those value stocks really started to outperform. And some of these stocks are up, 50 to 100%. Look at JP Morgan, Bank of America, Wells Fargo is up, quite a bit. Boeing is up tremendously. Since then, Disney's up a lot. So when we talk about some of these large caps that are up so much, and even like some of these broken down stocks like Royal Caribbean and Carnival, some of these stocks are up so much from their March lows, but a lot of them didn't really break out until November. What are your thoughts on, this methodology where it may not be screening for some of those companies, but at the end of the day, a lot of those companies ended up having a pretty significant move up there. So, and then the other question when you had this screen up here about some of the oil stocks I saw in there, with the new, I guess, ESG investing, a lot of these funds and some of these schools that have endowment funds that they're saying, well, we're not going to invest in energy because it's not ESG, essentially. Do you feel like that with this method, it actually avoids some of those companies, or can it still capture those?
Oh, that's a great question. And I think it does tend to avoid that a little bit because there's not that's huge growth in earnings and estimates for these type of companies. But if you're a little bit more active, you can follow the rotation a little bit. But I think the big money isn't really made in the banks and the mining stocks. The big trending stocks are going to be the disruptors, the Netflixes, the next Amazon, which are usually in the growth space. Even Home Depot, back when it was making its big run, it's a blue chip now, obviously a slower mover, but it made its big run with those incredible earnings estimates and all of that. So it's fine. Rotation, it happens. Growth went so crazy in 2020 that it was kind of normal to see some rotation back into the kind of lagging stocks, especially as things are opening up a little bit more. But I think the big money is made with sticking with the big growth leaders, which is why I don't delve too much into the oilers, the miners, the banks, which are the leading industry groups right now. So if you are a bit more active, you can trade that. But personally, I'm trying to position in potential leadership groups that are still disrupting.
Right.
Yeah. I don't know if that answers your question, but
no, it does. No, it makes sense. Yeah, absolutely.
Cool. So I guess applying CANSLIM, I think for stock selection and getting a good universe of stocks, you really only need a screener that can scan for earnings, sales growth. That should give you plenty. This is just a screenshot of the IBD stock screener, which is available with the digital subscription. I use MarketSmith personally, but it's definitely a much more expensive option than the stock screener, which I don't think too many people know about. So I think it's good to spread the word about it. But you can basically screen for a bunch of different criteria. I've got a minimum RS rating 85. So basically the price action has to be doing reasonably well. Price is greater than $10. Last quarter sales over 20%. Last quarter over earnings growth over 20%. And the estimates for the current year over 20%. And that gives you 63 stocks. You can see some great winners here. Apps, Futu has been strong, GRWG, DQ. A lot of these stocks that have been doing well have been appearing on the screen as soon as their numbers basically reflected a lot of growth in the company. So this is a great screen, I think, to catch some potential big winning stocks. So that's a little bit about screeners. FinViz, the numbers don't always kind of match up with IBD side of things, but that's still a pretty good option and it's completely free.
Is MarketSmith part of IBD? Right?
Yes. It's all part of the O'Neill companies. IBD is the more kind of for the public product. MarketSmith is their kind of premium product for people who are definitely more advanced and a little bit more along their kind of journey as individual investors. But also the IBD digital subscription, it's great for learning about CANSLIM. They've got so much educational webinars and all of that. So if you haven't checked it out and this is the kind of the first time you're hearing about IBD, it's funny because I interview a lot of traders. The money manager, US investing champion last year, he basically found IBD because his wife got the IBD newspaper instead of the Wall Street Journal one day at a gas station. That basically changed his whole life. So check out IBD if you haven't already. And yeah, check out the screener as well, because I think it's a great option.
Yeah.
Yeah. Cool. So going into the technicals, this is kind of the meat of everything, because stock selection, you can run screens all day, but it's really about how you manage positions and buy and sell. That's really going to drive that performance. So some guidelines here. I want to enter when supply and demand characteristics are in my favor. I want to see as little overhead supply, meaning a stock, there's nobody up above waiting to sell to me. I want the stock to be in a long-term uptrend, meaning that in general, institutions are in control, buyers are in control over the long term. So an increasing 200-day moving average is something I always want to see. And I want to see accumulation signs, as we said, we talked about a little bit. Large up volume days, large earning gap ups, tight price action on low volume, relative strength signs, and trending above the key moving averages are all things that I look for when deciding whether a stock chart looks good and whether it's worth my money. And we've got a question here. Sunny, can you please share the IBD screener shot?
I'll post that
Yeah.
link in a little bit here for sure.
Cool. So in terms of buy points, CANSLIM kind of has two main ones, breakouts and pullbacks. First, talking about breakouts, the stock should be in a longer term uptrend. I think a lot of people kind of mess this up and don't quite learn it the right way. Before a cup and handle, which is a type of base here, the stock should be in an uptrend, at least 30%. People will see a downtrend, then it moves up a little bit and then forms a cup, and they're like, that's a cup. Let's buy the breakout. But no, that's a longer term downtrend, just the start of an uptrend. That's not a constructed base. We want a longer term uptrend so that this base is just the weak holders being shaken out and transferring their shares to the longer term funds. That's what's going to lead to a continuation like this once the stock makes it back to all-time highs. So I think that's an important part. You always want to look for a longer term uptrend and then bases within that. So a longer term uptrend, and then we're buying the bases and dips within that trend. And also when we see a breakout, which is basically a move through that prior high or other very important consolidation area, the breakout should be on above average volume. So 50%, 100%, even 1,000% above the daily 50-day moving average volume, which you can see down here. And this is because we want the breakout to not be from a bunch of traders, retail investors who together done with the market. We want institutions to be behind the move, and we want them to be buying stock because in general, the trends are made by the institutions, not all us retail traders. We cannot move the markets for an extended period of time, and we want the uptrend to last a few weeks, a few months, even ideally a few years. So we want that breakout to be on huge volume. That's just another sign of institutions being behind the move. Right. And here I've got some base types. I don't have slides for all of them, but we'll go through examples and I'll point out some base. But basically a cup and handle is a consolidation, a move up to the prior pivot, then a little bit of a consolidation below that high, and then the buy point is through that handle high here. And this is a cup without handle, meaning there's no consolidation. It breaks out, and then maybe because there wasn't that consolidation, it kind of rests right above that pivot and then continues to move on.
Yeah.
And
I just want to, I wanted to interrupt you because
Sure.
I have a good friend in this group. His name is Mark, and I just want him to know that a cup can exist without a handle. And here's an example. And whoever he was, or whoever was arguing with him about that should know this too. So Mark, there's your win right there.
Right. Yeah. Often the cup will, if there's no handle, it'll rest later. But yeah, for sure they can happen without it. I think Peloton had one recently. But yeah, there's tons of examples just looking back on charts. The double bottom is similar to a cup, but it forms a kind of W shape. Mm-hmm. And then the pivot is that center consolidation area. So that often happens when the market rallies, then pulls back again, and then rallies again. The overall market is going to form these shapes. So if a lot of stocks look like cup and handles, that probably means the QQQ or the NASDAQ also looks a little bit like a cup and handle. Mm-hmm. And then we've got a flat base, which is just a kind of pretty tight consolidation pattern. where it doesn't really correct more than 20% from that high. And those are pretty common as well. And a very important thing when it comes to breakouts is you want to buy as close to that pivot price as possible. And this is because often the stock will pull back to that pivot. I think about 40% of the time it pulls back to the pivot, if I'm remembering the statistics right. But buying as close to that pivot means you're not going to face as much heat, as much pressure, and hopefully you're within a profit that first day, that first week, and that just makes things smoother on your end. You don't have to deal with the kind of mental aspect of a position moving against you. Buying as close to that pivot protects you. But the other side of things is if the stock doesn't manage to continue to break out and actually draws down 8% from that pivot after breaking out, that's a warning sign. That's telling you that the conditions aren't quite right. The market conditions are not right. And that's a sell signal for me. I want to be out 3 to 5%, not 8%. So this is kind of the max per CANSLIM, but I personally want to be out a lot faster than 8% loss on a full position. But that's just my own kind of personal process.
Yeah. Can we talk real quick about, the last few days? Obviously, the market's just been very, very choppy. I mean, you saw on, I think Monday, I think the NASDAQ was up maybe 1%, then yesterday was down. And today it was one of those things where it's down 1% and change, and then it closes up, I think 0.5%. So very, very choppy trade, very, very choppy tape for the last few days. In those kind of situations, if you look at some of those high growth stocks, I mean, I'll give you an example of even a Peloton, for example, today, or Lemonade. I think I saw how some of these stocks were down 5, 6, 7%, and then they ended up closing either higher on the day or maybe flattish on the day. So how do you manage something like that when the volatility is so huge in some of these stocks? I think today another example of that was Mohawk. That's a big growth company right now, and I think it was down 8, 9% at one point, and I think it ended up closing up 5 or 6% for the day. So those are some big moves within a day. Open was one of the stocks that I think had a total move of 35% last week in one day,
Right.
from the time that the QQQ basically kind of bottomed out for that week and then started to kind of move back up. So how would you manage something like that?
Great question. I think my answer is I try to avoid stocks that are so volatile because it's really hard to manage risk. I'm usually putting my stop loss at the low of the day, the low of the previous day. And if that's 10, 12%, I can't position that stock per my own risk. So I either size down, trade a half position versus a full position, even a quarter position if things are very choppy. But I think my best answer is I don't try to position at all in a stock like that. I want the price action to be tight because that's a sign of institutions are in control. When things get emotional and things get so volatile like that, that's kind of the last thing we want to be as retail traders, be involved there. Let the institutions fight it out. Wait for that nice tight price action that will happen if a stock is going to go from 20 to 100. There's going to be a time to position. You're never going to miss out on a move because you wait to manage risk. When I look at a chart, I learned this from Ray. The first thing you do is ask yourself, can I manage risk here? And if the answer is no, don't position that stock. If you really want to be involved, you can also look intraday, trade the kind of more short-term consolidations on the 65-minute charts, 50-minute charts. But there you're kind of shifting up your style, and that's not good to do either. If you're a position trader, you don't want to be trading, you don't want to become a day trader. That's not going to work out well. You want to stick to what works, and if what's worked for you in the past isn't working right now, that means the market isn't right for your style, and you have to sit and wait.
Yep, I agree.
Yep. So the second type of buy point is a pullback to a key moving average or to a prior pivot, a significant level in interest. And the pullback should be on low relative volume because we don't want the pullback to be a sign of institutional distribution. And if the pullback is on high volume and also a very quick move down, that's a sign that things might get a little bit more volatile and institutions are distributing stock. But if it's a slow drift, it happens over a few weeks to a key moving average, that's what we want to see on much lower volume than I've got the 20-day moving average here. So you can see that the breakout here was on high relative volume, but it doesn't quite get going here, it goes sideways. And this is actually Roku. So this broke out and went on 200% move, but it presented a buy point at the breakout here. If you bought right near the pivot, you were in profit right away. The best stocks do that. The best breakouts get you in a profit that first day, the first 2 days, but then it does kind of just go sideways, drift into the moving averages, and then gap up and go again on high volume. But the key thing here to remember is a pullback to a key moving average should be on below average volume and much lower relative to the breakout move. And it happens once again, we get another touch of the 50 and 21 EMA here, and another huge move up on volume. And then this thing really gets going. So look for those signs, big volume up days. And when it does pull back, you don't want to see it to be an 8%, 12% drop in one day, a few days. You want it to be a slow drift back into those key moving averages. And the first touches of a moving average after the true breakout are the highest probability setups to either start a position or add to the existing breakout position. And ideally, as we got here, we've got really tight price action. Look how tight this is. And there's a sign again that supply is drying up. Institutions are absorbing any supply that comes to market. And this is very, very constructive and definitely something that you see over and over again if you look at charts of stocks that go up 100, 200%.
Right.
So yeah, I guess managing risk, and it is something that we should for sure talk about. It's focus number one, as I said, cut losses, cut losses, cut losses is what keeps you in the game as a trader. And as I said, I want to see much less than 8%. Because your performance is a function of these three characteristics: your batting average, what percent of your trades are winners versus losers, your average gain on those winners, and then your average loss on your losers. And if you can minimize this as much as possible, your gains will take care of itself. And you can actually only win one out of three trades, three positions, and still make so much money. So basically controlling your loss, which is really the only thing you can do in the market by using those stop losses, managing risk, is the key to being sustainable and in this game for the long term. And Mark Minervini, who I highly recommend his books, he really emphasizes this: manage your losers, cut losses, cut losses, cut losses. That's how you can get really extraordinary returns, because you're not giving much back. If you let a stock, as Sonny, I think you mentioned earlier, drop down 50%, you don't just need a 50% return to get that back. You need the stock to double to just get back to where you were. But a 3% loss, with a 3% loss, you basically just need a 3% gain to get back to that level. But as you let those losses increase and increase, it basically works geometrically against you. So keeping those losses tight means it's very easy to get them back in that stock or another stock. And this is another important thing, because just because a stock stops you out once doesn't mean that it's not a good stock. It just didn't work out that time. Pinterest last year frustrated so many people after it gapped up on earnings, clear sign of institutional accumulation, and then just went sideways up and down for a month or so, trying to break out a few times, getting knocked down each time. A lot of people took stop losses a few times and got tired of the stock, and then it went the next time. So keeping those losses small keeps you mentally in the game, because you're not afraid to try the stock again, give it another go, basically. So I've got a note here: cut losers ruthlessly and let winners trend. That's the key.
Yeah, I love that, because I think there are too many people that, once they start losing money on a stock, they'll hold on to it with the hopes that, maybe it's going to go back up and I'll break even and I'll sell it. And that's the thing, like, you got to know, if you've lost some money on a stock, you sell it, you move on, and you find another trade.
Yeah. There's a reason you lost money. It's not market manipulation. It's not any of that. It's because the market was not right for that stock or the general market at that time. So you should never be hoping in the market. Everything should be rule-based and based on analysis of your performance. And you can go back and calculate these and basically calculate where you need to cut your losses to improve your performance. Because if you average 10% gains, and you have a 40% batting average, so you're right 4 out of 10 times, which is pretty good, honestly. You can't let those losers go down 10% because the math just doesn't work. You won't be a profitable trader. You want to cut those losses about 2 to 3 times your average loss. You want to cut your losers about 2 to 3. How am I trying to say this? If your average gain is 20%, you want your average loss to be half to a third of that. And that's what's going to keep you in the game for a long term. Keeping those losses much smaller relative to your wins, that is the key. Right. And if you can say that better, I'm not quite getting that across as I want to.
Right.
Yeah. So a 2 to 1 gain to loss ratio to 3 to 1 is superb. That means that your batting average can be even 30% and you'll still make money. That's the key. And ideally, in great market conditions like we saw in 2020, you'll be right a lot more than 4 out of 10 times. And what's that going to do? That's going to really increase your performance because you'll be hitting a lot more of those average gainers, and you'll still have losses even in a great market, but keeping those losses small in any market is the key to not giving back much even during a downtrend.
Right.
So this is kind of the topic that everybody has questions about. When do I sell? When do I sell? When do I sell? Buying kind of is the easy part. It's not easy, you'll be wrong, but it's kind of simpler. But when to sell, when you're at a profit, things are working, it's hard to sell that position and realize those gains. But what I do is I kind of wait for a change in character in the stock. So is it breaking key moving average that it's respected for the entire run? As we see from NEO here, it broke the 50, that it didn't even come close to touching until here. But this day right here, it finally broke it and closed below it. You also want to be able to look out for high volume pullbacks. So as I said, on pullbacks, you want to see low relative volume. But if you look at the chart of the trade desk, TTD, the pullback that started this base, I think was down 12% on huge volume. And that led to a couple month-long decline. You don't want to be stuck in that, wasting your time and capital in a stock like that. You can also set profit targets. I don't really do this. But obviously if you're more in the consistency phase versus performance, and you're looking to just kind of turn over your portfolio and basically get quick, more swing trading style, you can basically sell at 20% gains. If your losses are 8%, that's great. That's just going to consistently build your account. You can also sell when a stock is a certain percentage over a moving average. That's a way to sell into strength. If you look back in history, and when a stock is 20% above its 10-day moving average, it always pulls back, and either pulls back to a key moving average or pulls back dramatically and forms a base. That could be a sign to kind of sell a half of your position and ride the rest for the longer term move. You also want to be on the lookout for wide and loose price action. Sonny, we were kind of talking about this. When a stock has 35% ranges like Open had, that's a sign that institutions aren't really in control. There's a lot of volatility here, and that's the opposite thing that I want to deal with. So when stuff gets wide and loose, especially after it's already up 200, 300%, that's a sign that the character is changing in the stock, and I don't really want to be involved at that point. I want to either sell my hands or look for stocks that are just starting their uptrends. So we mentioned this before. We buy on technicals with CANSLIM. We buy on technicals and fundamentals with CANSLIM, but we sell only on technicals.
Would you ever sell if it only breaks the shorter term moving averages like 821, or do you wait for 50?
Great question. I'm not quite position trader. I'm not quite a swing trader. I'm kind of in between there, but I definitely will sell most of my position when it breaks to 21. That's just kind of my preferred time frame. Definitely, if you're more the investor, you can sell longer term moving average. The 50, even the 200. I know a bunch of great traders who like to buy right near the 200 day, and only will sell. You can see this would keep you in the stock here with NEO. Only sell when it breaks the 200 definitively, and this keeps you in the big moves. If you want to catch all of Amazon, you can't sell out when it breaks to 21, because it's going to during its run. It's 100% going to. But you can always sell a little bit when it breaks the 10, sell a little bit when it breaks to 21, sell a little bit and sell the rest when it breaks the 50. You can stagger your sells, so you're riding a portion for the bigger move while also making sure you're not giving too much back by selling when the short-term character changed, because there's a long-term character, the longer-term moving averages tell you that, and then there's the shorter-term fluctuations, which is harder to time, but you can compound your account really well if you sell into strength here. But it's just kind of a different game. It's all about your own personality, your time frame, and how you want to do it.
Mm-hmm. Well, let me ask you about an example of Teladoc, right?
Sure.
I mean, you've seen the growth rates haven't necessarily changed as much, but I think it's trading below 200-day moving average now. What do you do in situations like that where you know that the growth story necessarily hasn't changed, but something is going on? I mean, with that stock where it's basically not responding to the market starting to maybe move back up, or just not responding back to the way it used to be maybe just a few months ago. What do you do in something like that?
Good question. So with Teladoc, the example, and we can take a look at the chart later, but it broke out on low volume to a new all-time high, and then pulled back, really closed below the 21 with a very poor closing range on higher volume. That's when I sold the last of my position. And then it fell back into the prior base on large volume. Another huge red flag if you're still in the stock at that point. So like I said, once I'm in a position, I can believe in the story as much as I want, but if the technicals are not lining up with that thesis, if the character has changed in the stock price, that in the end of the day is what gets you paid, the stock price. So I'm not going to hope that it recovers, stays above the 200 as it's falling back in the base. I'm going to sell, move on, and wait for it to set up again if I want to get involved again.
Right. Awesome.
Yeah, so here are a few case studies, and we can either stay in the presentation or we can actually look at these live in MarketSmith or TC2000, whatever you want to do.
Sure.
But I guess I'll just stay in here for now. But anyway, apps, great performer. It often starts, these huge runs often start with earnings gap ups. We have a few during this run, and it's scary to buy on earnings when the stock is up 20% on huge volume. But that's a sign that institutions are buying shares because they're not caring what the stock price is. They're just bidding up the stock. And especially if it's the highest volume ever, as was the case with apps. So this was down near, I can't quite see. There we go. This was down near 10 when it gets started, but it presents so many opportunities along the way to get into the stock. And now it definitely has gotten kind of wider and looser when the screenshot was taken. So for me, it's kind of a sell signal back up here. Especially when it breaks the 50 for the first time in a while and all of that. But yeah, definitely a great stock to go back and study, go bar by bar. Based on your rules, where would you get in? You've got a nice kind of breakout from a short-term shelf down here, bounce off the 50. There's many opportunities to get in the stock. You've got increasing fund ownership from 43 funds to almost 400. So a 10x in the fund ownership, one high quality fund in there. Great growth rates. So this definitely should have been on your radar in 2020 if you were following the cancel methodology. And people on Twitter were all over this. Everybody after this latest earnings breakout, I think everybody had it on their watch list. It didn't present a good buying opportunity really until this kind of short-term base. So definitely one to study and go back and see how you would have traded it. Next, yeah, go ahead, Sonny.
No, I was going to say I love that chart because you can really see just in the last couple of weeks how the volatility has increased so much, and then you really kind of start to question, now where do you go from here? Do you buy the stock because it's pulled back from 100 back to 70s, or do you just basically look for some price stability at this point?
Right. I mean, O'Neill would call this improper action. Ross Haber's been all over this. He's been talking about the wide and loose. Previous big winners in 2020 they don't look proper right now. They're not great price structures. I mean, this already had a 10x move. How much can you expect in a short amount of time from this type of stock? If it needs a base, it needs a nice longer term base to shake out the weak holders and set everything up, get everybody's eyes off the stock so institutions can accumulate. And then maybe if it keeps performing as it's been doing, then it can start a new uptrend. Now, it could completely go up to 100 and break out and continue this trend, but a little bit of the character has changed at this point, in my view.
Right.
And we're definitely seeing character change with Peloton. And we talked about how the 200-day, a lot of people like to buy along there. It found support there nicely. And overall, once again, a huge move up. Didn't give you too many buying opportunities, honestly, but it's such a powerful move. But then it had a stage one consolidation. This is kind of cup shape. It's a little bit deeper. That's why pattern rec doesn't have it as a cup. But anyway, it was a nice move. I owned it from, I bought the breakout. There's like 4 tight days here against the 50. I bought this day right here, wrote it up here. I think sold a little bit here, bought a little bit back here, sold a little bit, and then finally added here. It was moving nicely. And then this day was a huge expectation breaker. On a breakout, what my expectation is that the stock follows through on volume, continues to upside, because all the momentum on this day was to the upside. But the opposite happened. It moved down on higher volume and basically touched the 50. So I sold out of all the shares that I bought back on this day. I saw my position from down here. But then the next day, when it breaks the 50 and breaks these lows, I'm out of the rest of the position. And I was able to avoid all this mess to the 200 day. For me, the big money is made when the stock is trending above the 21 and the 50. I don't really want to be messing around here bottom fishing. That's not my style. Some people are great at it. There's certainly a ton of money to be made here, especially if you're a longer term investor. But for me, I want to be buying short-term consolidations within very strong uptrends in strong fundamentally ranked stocks.
Yeah.
Oh, here we've got the trade desk. So you can see what I was talking about here. It's trending beautifully, breaks the 50 a little bit, but survives, moves up again. And then this bar, this is a clear change in character to me. I mean, Sonny, I think you probably agree here. It breaks all these lows in one day on very high volume. And then it chops around. I actually tried it through these highs as it forms the right side of a little bit of base. But then once again, the next day, it's an expectation breaker for me. And I was stopped out for a small gain, avoiding this drop to the 200 day. So I'm not a genius because I avoided this drop. It's because it broke the rules, and it could have taken out this high and continued to move up, and I would have been wrong, and I might have been able to buy it back. But following your rules, following your stop losses protects you from the 20-30% drops, which are killer for any account that you really want to compound rapidly.
Absolutely.
And you can see that the estimates for 2021 aren't quite as strong. The revisions are good because of this green triangle here, but you do have some nice growth for 2022. So we'll see if this is just a longer term base. This is definitely a disruptor in a promising space. Fund ownership is still growing. You've got 4 high quality funds in here, but I think it just needs time, a longer term base to set up, and then maybe it forms another right side of the space and challenges these all-time highs.
Have you been able to find stocks like through all this choppy trading the last few weeks? Have you been able to find stocks that are actually working?
Yeah, I've tried a few stuff. I've been putting kind of test trades on, seeing if they worked. Currently, I own Snapchat and also Bumble, which is a recent IPO. I had Etsy and Twitter this morning, but I didn't want to let a stock go red to green on me. And when the market is below the 50 and stuff isn't acting quite right, I'm going to be a lot faster cutting my positions versus when stuff is working, my other positions are doing well. So Etsy and Twitter, I got stopped out for small gains this morning, but I still have Snapchat and Bumble, which recovered well after the morning drop down. But yeah, the hardest part, the most active management, is when you're first establishing those positions, because there you have less profit cushion to work with, and it's harder to let those natural fluctuations of the market play out and see how it turns out. But yeah, Snap, Twitter, and Etsy are stocks that have great fundamentals. I'll still be watching them. If they set up again, I'll have no hesitation to buy them back, and I'm able to do that with a clear mind because I'm not letting them move too much against me. I have no problem buying them back when they tighten up again and set up another buy point.
Right. Perfect.
Yep. So that's the trade desk. And next up, we've got Tesla. Definitely one of the best performing stocks of 2020, as we saw from that IBD document. And all of this move in 2019 actually started from another earnings gap up. So this is a key thing to look out for. Look for earnings gap ups on huge volume that can really start a very strong uptrend. And then it actually had almost a climax run here, but then fell to the 200, set up again. So this is kind of what I'm waiting with Peloton and TDD and all of those. is for them to set up the right side of a base, tighten up again, and then move up on volume. And a previous winner is a great place to look for new opportunities, but they have to set up right with the price and volume, supply and demand characteristics. And you've got tightness here, moves up on big volume, pulls back to moving average on low relative volume. You can see it's below the 50-day moving average, moves up again, has a longer term base. Look at the volume decrease within the space. This is textbook. And then the huge volume on the breakout. And then you're at a profit right away. It has a short kind of consolidation here, not really actionable, but then it moves up to 900, tries to establish itself here, but breaks the 21 a few times. So I probably would have let go a little bit of this position here, falls back to the 50. This is a character change here, move through the 50. And now it's kind of in no man's land between the 50 and the 200. So nice rally day today. If it can take out this high, that's the start of something. But still, this is basing, and I want to be catching a stock when it's kind of already developed the right side of its base and is potentially ready to challenge all-time highs. I don't really want to be involved when it's still base building. That's potentially a waste of capital and time and energy.
Right. Yeah. Do you think, from the interest rate standpoint, obviously, I mean, I've drawn plenty of charts where you can see interest rates all over the place, you know, over the last 20 years. And the SPY, NASDAQ, I mean, they've trended up, obviously. But generally speaking, I mean, for now, are you paying attention to the interest rates where you're like, you know what, maybe the yield's going up, I got to stay out of this for now? What are your thoughts on that?
Again, I'm kind of leaving it to the price action. We definitely saw a lot of volatility because it was in the news, all the interest rates going up 1.6% or whatever value it was. But all of that's going to play out in the price action. The institutions have their plan, and they're either going to sell or accumulate stock depending on what the macro conditions are. And then I can read that price action on the charts and basically make my decisions based off that.
Perfect.
Great question. Yeah. I think the last case study I have is Zoom. This really showed some signs early on, because when the market, look at this, is the SPX line here, the market's decreasing. And I think I said earlier that when the overall market is down 30%, you expect growth stocks to be down twice that, 1.5 times that. And Zoom was going up. This was screaming at you, making relative strength to all-time highs. During a correction, it was telling you something special is happening. And it was a little volatile. It was definitely hard to position down here. I actually bought it here. I think sold it here. I didn't catch this nice run, but I got a good few trades here. Here and there. I bought it when I reclaimed the 50 here. But this is a textbook example of RS. Great earnings. I mean, probably the largest earnings growth we'll see for a while. But then once again, it had a character change, broke the 21 for the first time during this uptrend, broke the gap down through the 50. The 50 turned down. It couldn't retake it here. And this is another one that just needs time to build a right side. If we think about this as being potentially symmetric, this might need a few months here to really shape up if it's going to. And right now it's so volatile, it just needs time. Below the 200-day is a no-no for me. Basically below the 50 is a no-go for me. But we'll see what happens. It could potentially rally, but if it does rally to 600 from this point, it will tighten up. It will show a good low risk entry for me to position. And I did try it, actually, thinking this was the right side. I tried it. I positioned here, added a little bit more here, but then got stopped out on these days. So it's kind of a game of managing risk. And once the character change happens and the market tells you that you're wrong, you got to get out and manage that risk, right, and take what profits you got.
Yep.
And once again, huge fund ownership growth, Fidelity Contra funds in this. But yeah, going from 278 funds to 1,415, that's going to show up in the price action here, like it did with Zoom.
Yep.
And another case study I've got is DOCU, and this is actually a video that I did with Ross. And a little bit about Ross. So William O'Neill is the founder of CANSLIM, the kind of entire methodology he ran. He had a bunch of portfolio managers. Ross was one of them, so he learned directly with Bill, directly from Bill, who's William O'Neill. And we basically walked through DocuSign, how to position in it, buy points, winning characteristics. You can find this video walkthrough here. And we've also got a free 2020 model book if you want to kind of analyze the best winning stocks from 2020. We go through all of them, analyze buy points, sell points, character changes. So if you want to practice your kind of technical analysis, this is a great option for you. So I thought I'd point that out. Yeah, that's pretty much the end of my presentation. If you guys have any questions, I'm happy to answer them. And here are my links if you want to check me out, and also the Trailline links, which I think is an excellent resource. We're going to be putting out a bunch of great content. But yeah, hope you guys enjoyed this and stuck around, and I'll be happy to answer any questions you guys have.
No, this was a lot of fun. I appreciate it so much. I think one of the questions somebody asked was, can you also do this with crypto? I mean, you've seen obviously Bitcoin's had some huge moves last year and again this year as well. Have you been able to do something like that with crypto also, when there's really not like an earnings growth, or there's no revenue,
Right.
there's none of that stuff coming on, it's all technical. Do you think that that's actually possible, or is it just that FOMO trade right now?
That's a great question. So crypto has different fundamentals than stocks, which have earnings. They produce, they're a company. Crypto has different uses, and we'll see which ones actually are useful to our society. And those are going to be the ones that do well, whether it's Bitcoin, Ethereum, one of the other ones, Polkadot, all these different names. Yeah, I'm personally not very knowledgeable about crypto, so I'm not really involved with that space. I have traded SI, Silvergate, which it manages the transactions. So they actually make money just on trading a Bitcoin and the exchange of all those different cryptos. And their earnings are going through the roof and have great earnings estimates. So that's kind of how I've been playing the space. I've been trading that a few times. But yeah, crypto, anything that's traded on the markets follows supply and demand. There's going to be a chart pattern that you can trade and manage risk. So some people only look at technicals. Like I said, some people only look at fundamentals. If you're just a technical trader, you can for sure go into crypto. Or even if you're only a fundamental guy and you know the story about these cryptos, what it's going to be used for, you've got the vision, then you can go ahead and play the space. Personally, I'm more comfortable sticking with stocks for now and trading some crypto related companies that are benefiting as well from this strong trend. I mean, it is a very strong trend in 2021. It's one of those leading groups, I think. So it's definitely good to be involved in some way, and kind of SI is the way that I've chosen to be involved.
I like that. I like that a lot. Yeah, man. Thanks so much for coming on. This was, I think we said 60 minutes, but we're 1 hour and 40 minutes into this. So I told you it's a lot of fun. So, and time flies. So thanks so much. I appreciate you doing this. We'll have to, try to get you back on at some point in the future, and we'll learn some new things from you.
Yeah, I'd be happy to. And thank you, Sonny, for having me on, and for everybody watching. Thanks. And I hope this is useful to you. Definitely, I'll try, Sonny, to get Ross and Ray from Trailline here on here. They're super experienced and have taught me a bunch of stuff. So they give a whole new perspective on everything. But yeah, thanks again for having me. For everybody watching, I hope this is helpful. And yeah, check me out on Twitter. Happy to connect. And I hope you have
those YouTube videos are absolutely amazing. So if you guys haven't, if you guys get a chance, watch some of those. I mean, those are really nice. And of course, like your Twitter feed is super educational. So so that's a great resource right there as well.
Awesome. Thank you.
Awesome. Well, thanks so much. Hang on, let me just end this Facebook. So thank you all. Talk to you guys soon.